How much money would you need to invest in order to quit your job and live off of dividends forever? It's an interesting concept. I mean, who wouldn't like the idea of giving up the 9 to 5 in favor of relaxing on a beach while your investments pay for it? And given the amount of videos covering the topic online, it must be possible, right? In this video, we're going to explore the realities of investing in dividend stocks, and by the end, we'll have decided once and for all whether living off of dividends is actually feasible and what you need to invest in order to get there. Before we get started, let me know whether or not you invest in dividend stocks, and if you do, which ones and why. Alright, let's begin with a very quick recap of dividends. The formal definition of a dividend is a sum of money paid regularly, typically annually, by a company to its shareholders out of its profits or reserves. In other words, when you invest in the stock of a company, the company may choose but is not obligated to pay a dividend. Some companies pay a dividend, some companies don't. Why? Well, because different companies reward their investors in different ways. A dividend is one of those ways, but there are others, such as share buybacks. Assuming you've invested in a dividend paying company, you'll receive your dividend either every month, quarter, half year, or year, again depending on the preference of the company. And the value of your dividend will depend on how many shares of the company you own. For example, if the company pays a dividend of 50 cents each month for every investor share and you own 10 shares, then you'll receive €5 each month. Naturally, the higher the dividend per share and the more shares you own, the higher your dividend will be. That brings us to a very important concept for this video: dividend yield. The formal definition of dividend yield is a dividend expressed as a percentage of a current share price. And as we can see, the formula is the annual dividend per share paid by the company divided by the company's current share price. Don't worry if that sounds confusing, we'll be doing lots of examples. But what this tells us is the kind of value for money we're getting by investing in one dividend paying stock over another. Not every company pays the same dividend, and not every company has the same share price. So a company who pays a very small dividend relative to its share price on paper is worse value for money as compared to a company who pays a very high dividend relative to its share price. That's very important when we're trying to work out what dividend stocks will best allow us to sip cocktails in Bora Bora forever. With that in mind, let's talk about how much you need to invest to live off of dividends. Alright, so we're going to assume that we have an annual salary of €40,000 and we want to quit our jobs and replace all of this with nothing but dividends. If your actual salary is higher or lower than €40,000, you'll still be able to use the exact same method, which I'm going to use in a second, to work out how much you need to invest to fully replace your salary with dividends. So all we have to do to figure out how much we need to invest is to take our salary and divide it by the expected dividend yield of our investments, expressed as a decimal. So for example, if we expected a dividend yield of 5%, we would need to invest €800,000 in order to receive €40,000 each year in dividends. All we're doing here is reverse engineering the calculation of dividends. If I said to you that we had an €800,000 investment in a stock at a 5% dividend yield, we could pretty easily work out that our dividend will be €40,000. We're simply doing the opposite. We've started with what dividend we want to receive, and we're using different dividend yields to work out what kind of investment we'd have to make to get there. On screen, you're seeing how important dividend yield is when it comes to how much we'll need to invest in order to fully replace our salary. At a 1% yield, we need to invest a whopping $4 million, whereas at a 10% yield, we'd only have to invest 400 grand. Obviously, there's a very significant difference between having to invest 400 grand and 4 million. And for the vast majority of us, investing 4 million just wouldn't be feasible. So at this stage, you can take it that in order to live off of dividends, we'll need to be investing in stocks which have high dividend yields. We will come back to this point, but just keep it in mind. Alright, so how does all of this fit into real world examples of dividend stocks? If you didn't know, the best place to start when researching dividend stocks to invest in is the list of dividend kings and dividend aristocrats. The companies on this list are considered to be some of the highest quality dividend paying stocks in the world. In order to be included on the list, the company first needs to be a member of the S&P 500. The S&P 500 is a stock market index which measures the stock performance of the 500 largest companies in the United States. In other words, the companies on this list are some of the largest companies in the US. But that's not all. In order for a company to be considered a dividend aristocrat, it needs to have not only paid but also increased its dividend each and every year for at least 25 consecutive years. For dividend kings, the bar is even higher, and the companies with that classification need to have increased their dividend for at least 50 consecutive years. Now, this is no small undertaking. Remember, companies don't have to pay a dividend, and the companies on this list have continued to pay and increase their dividend throughout periods of economic turmoil, like the dot-com bubble, the Great Recession of 08-09, and the global pandemic. So in terms of picking dividend-paying stocks to invest in order to replace your salary, these companies have proved time and time again that they're reliable and resilient. So how much would we have to invest in some of these companies to replace our salary? NerdWallet put together a list of the top 25 dividend kings and aristocrats by dividend yield, meaning at the time this list was put together, these were the companies who offered the best value for money in terms of how much dividend you were getting from your investment. The reason why I say at the time is because dividend yields are always changing. Company share prices change every single day, and as we know, the current share price is used in the formula for working out dividend yield. But considering most companies tend to pay their dividend on a quarterly basis, and assuming there hasn't been any massive declines in the share price, dividend yields on websites such as these tend to be reasonably accurate for at least a few months. But don't be surprised if the dividend yields are different when you go to check them yourself. So this is telling us that Walgreens offers the highest dividend yield on the list at 5.05%. We can use our calculation from earlier to work out that in order to replace our salary of €40,000, we'd need to invest €792,079 in Walgreens at the current share price. Walgreens stock is currently trading at $39.89 at the time of recording, and given how close the euro and the dollar are to one another at present, we won't factor in any currency changes. That means you'd need to purchase 19,856 shares in Walgreens in order to receive the necessary dividend to replace your salary. Take another example, ExxonMobil. Exxon offers a dividend yield of 4.09%, so we'd need to invest €977,995 in Exxon in order to replace our salary. At a current share price of $94.48, you need to purchase 10,351 shares for that to happen. You could do this all day, but here's the point. Even the company with the highest dividend yield on the list of companies with the most reliable dividend still requires an investment of €792,000 in order to replace our modest annual salary of 40 grand. People who earn 40 grand simply don't have 792,000 lying around to invest in Walgreens. Plus, investing that kind of money in one single company would be risky because your entire income will be dependent on the financial performance of Walgreens and its ability to continue paying your dividend. So in reality, we'd probably end up investing in lots of different companies, most of which would probably have a lower dividend yield than Walgreens, meaning we'd have to invest even more than 792 grand in order to replace our salary. And that's before we even consider the impact that changes in the company's stock price has on investment returns, with Walgreens stock losing investors over 50% of their investment since 2017. So this idea that the average person can invest in the stock market, quit their job and live off of dividends isn't really rooted in reality, especially over any short period of time. Remember earlier I said that in order to live off of dividends, you'll need to invest in high dividend yield stocks. Well, you might be asking, why can't I just find a stock that offers a 10% yield or a 15% yield or even higher? A stock yielding 15% would only require an investment of €266,000 in order to replace our salary, which is 66% lower than the €792,000 investment that Walgreens would require. And a quick Google search would show you that there are indeed stocks which offer 15% dividend yields. So why not invest in them? This is what's known as a yield trap. A dividend is only as good and as secure as the company who pays it. That's why the dividend kings and aristocrats are so popular, because they're reliable. Sometimes a company's dividend yield is too good to be true. Let's take a hypothetical scenario. Franklin Resources is a dividend aristocrat who currently pays an annual dividend of $1.16. Its current share price is $27.94 at the time of recording, giving it a dividend yield of 4.15%. Now let's say that Franklin comes out with some very bad news overnight about its future earnings and its share price declines by 50% to $13.97. There could very well be a period of time between the fall in the stock price and the next dividend announcement, meaning if you were to assume that the annual dividend would remain at $1.16, Franklin's dividend yield would actually increase from 4.15% to 8.3%. To an unsuspecting investor who was just looking for companies with the highest dividend yields, they might think this is a great deal. But in reality, those who have done their research know that Franklin likely won't have the future earnings required to support that size of a dividend in the future. Point being, it's not wise to invest in a dividend stock just because it has a high yield. You need to go and find out whether there's a reason why the yield is that high in the first place. So if it's not going to be feasible to live off of dividends anytime soon, does that mean that dividend stocks are pointless? Not at all. In fact, dividends are an essential component to investment investment returns. Point being, reinvesting your dividends to earn you even more dividends allows you to unlock one of the most powerful tools in investing: compound interest. Compound interest is best illustrated using a graph like this. The blue line represents the amount of our own money that we've invested, and the red line represents the same thing but with reinvested dividends. And as you can see, for the first 20 odd years of the investment, there isn't much difference between the two. But in the later years of the investment, we start earning huge returns, and that's the result of consistently reinvesting dividends over many decades. That brings me to my point. We shouldn't be looking at dividends as a way to replace our salaries today. Instead, we should be looking at them as a tool which we can use to create huge wealth in the future. Because in the future, you're going to retire from work, and that's when you'll truly need to replace your income. Many people refer to dividends as a form of passive income, which is accurate, but it isn't income that we spend, it's income we reinvest. Big difference. One factor we never considered earlier when we were talking about how much we need to invest to replace our salary with dividends is the fact that the dividend itself will naturally increase or decrease over time. If the dividend increases, which we wanted to, we'd end up earning more than our salary of $40,000 per year. If the dividend decreased, which we don't want it to, we'd end up with less than $40,000. But considering the ongoing value of the dividend in isolation isn't overly valuable, we also have to consider inflation. Inflation describes the increase in the prices of goods and services in the economy. Over time, things become more expensive, and the money which we have today will have less of an ability to buy things in the future. So let's say you're being paid a salary of €40,000 this year. If inflation between this year and next year is 5% and you don't receive any raise, then technically you've received a pay cut of 5%, even though your salary has remained the same. Why? Because what you can actually buy with that salary has reduced by 5%. So to maintain what's known as the purchasing power of €40,000 next year, we'd actually have to get a raise of 5% at a minimum to match inflation. The same concept applies to our dividends. The reason why we want our dividend to increase each and every year is not just because we're getting more money. It's because if it doesn't increase, its true value is being eroded by inflation. Again, that's why the dividend kings and aristocrats are so popular, because in order to have gotten on that list, they must have increased their dividend every year for between 25 and 50 consecutive years. So as an investor, you know that you're going to be somewhat protected against inflation. But again, the point isn't to spend dividends, it's to reinvest them. And because we want to reinvest dividends, that brings me on to taxation. If possible, you should invest in dividend paying stocks using retirement accounts. The reason why is because most countries will permit dividends to be reinvested tax-free if they're in a retirement account. What that means is that you get to keep all of the dividend for reinvestment purposes, meaning you'll earn way bigger returns from compound interest. Whereas if you invest in dividend stocks using any old brokerage platform, then as soon as you receive that dividend in your account, you'll likely have to pay some amount of tax on it at some stage in the near future. So that pretty much sums up my thoughts on dividend stocks and the reality of living off of dividends. Unfortunately, it's just not going to be possible for the average person to replace their salary with dividends anytime before they retire. As we've shown, it requires too large of an investment to do so, and where a smaller investment size is possible, there's too much risk. Instead, you should use dividends as a tool to unlock the power of compound interest and to build up a nice portfolio to support you in retirement when you really need to replace your loss of salary. Only invest in high quality dividend paying companies, and a great place to find them is the list of dividend kings and aristocrats. So knowing what you know now, what are your thoughts on dividends? Has this video changed your perspective on what dividends should be used for, or are you still going to try and replace your salary with them? Let me know in the comments. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers!